Hello everyone, welcome back to Stock Glimpse India. Today's episode is all about risk management in mutual funds. Now we've talked a lot about the potential for returns, but every savvy investor knows that understanding risk is just as important as chasing those returns. We work hard for our savings, right? So it's only natural that we want to protect them while they grow. So in this video we're going to demystify the different types of risks associated with mutual funds. More importantly, I'm going to share some practical tips and strategies that you can use to mitigate these risks and make more informed investment decisions. Because remember, when it comes to investing, knowledge is your best shield. Let's get started. So, let's start with a risk that's often talked about, especially when it comes to equity mutual funds: market risk. Now, the stock market, as we all know, is like a roller coaster, right? It has its ups and downs, its highs and lows, and that's precisely what market risk is all about. It's the risk that the overall market, like the Nifty 50 or the Sensex, might decline. And when that happens, the value of your equity mutual funds, especially those tracking these indices, could also go down. Think of it like this. You invest in a mutual fund that mirrors the Nifty 50. Let's say, hypothetically, the Nifty 50 takes a dip of, say, 5% in a day. Now this doesn't mean all your investments are doomed. It simply means that your mutual fund NAV, that is, the net asset value, which represents the per unit price of the fund, will also reflect a similar decline. And yes, seeing your portfolio in the red can be a little unnerving, right? But here's the key. Don't panic. Remember, we are in this for the long haul. Market fluctuations are a part and parcel of the game. Historically, if you look at the trends, markets have always recovered over the long term, and those investors who showed patience and remained invested have actually benefited from something called the power of compounding, which is essentially your money making more money over time. However, if you react impulsively to every market dip and sell your investments in a panic, you might end up realizing those losses and, more crucially, miss out on the potential rebound that often follows. So take a deep breath, stay calm, and remember that long-term perspective is your best ally when it comes to navigating market risk. Now let's move on to a risk that's particularly relevant for those of you interested in debt mutual funds: interest rate risk. Now, debt funds primarily invest in fixed income securities like bonds. And the thing about bonds is that their prices have an inverse relationship with interest rates. What does that mean? It simply means that when interest rates in the economy go up, the prices of existing bonds tend to fall, and vice versa. Let me explain this with a simple example. Suppose you've invested in a bond that offers, let's say, a 7% interest rate per year. Suddenly, the Reserve Bank of India decides to hike interest rates, and now, new bonds entering the market are offering a more attractive rate of, say, 8%. Naturally, investors are going to gravitate towards these new bonds offering higher returns, right? This makes your existing bond, which is still offering 7%, comparatively less attractive. As a result, the price of your bond is likely to decrease to align with the new market reality. And because debt mutual funds hold a portfolio of bonds, this decrease in bond prices can directly impact the fund's NAV, which means your investment value might fluctuate. So, how do we manage this? Well, if you're someone who prioritizes stability and wants to minimize the impact of interest rate fluctuations, you might consider opting for short-duration debt funds or liquid funds. These funds typically invest in bonds that mature over a shorter period, making them less susceptible to significant price swings when interest rates change. And here's a pro tip always, and I mean always, check the modified duration of a debt fund before hitting that invest button. Modified duration is essentially a measure of a bond fund's sensitivity to interest rate changes. The higher the modified duration, the more sensitive the fund is to interest rate movements. Keeping an eye on this metric can give you a better understanding of the potential volatility you might be signing up for. Now let's talk about a risk that often gets overlooked but is crucial to understand, especially in the context of debt mutual funds: credit risk. Now, when we talk about debt, we're essentially talking about lending money, right? And whenever you lend money, there's always a risk, however small, that the borrower might not be able to repay it. This is known as credit risk, or default risk. In the case of debt mutual funds, this risk arises from the fact that these funds invest in bonds issued by both corporations and governments. Now, while government bonds are generally considered safer because, well, governments are usually good for their money, corporate bonds carry a higher degree of credit risk. Why? Because companies, unlike governments, can go bankrupt. Remember the IL and FS crisis back in 2018? IL and FS, a major infrastructure financing company, defaulted on its debt obligations, sending shockwaves through the financial markets. Many debt mutual funds that had invested heavily in IL and FS bonds suffered significant losses. This incident was a stark reminder that credit risk is not just a theoretical concept, it can have real-world consequences for investors. So, how do we mitigate this risk? Well, the golden rule here is to prioritize quality over tempting yields. Always lean towards debt funds that invest in bonds with high credit ratings. Credit rating agencies like CRISIL, ICRA, and CARE assess the creditworthiness of bond issuers and assign ratings like AAA, AA+, and so on. The higher the rating, the lower the perceived risk of default. And here's a pro tip: be wary of debt funds that boast exceptionally high returns but invest in bonds with lower credit ratings. Remember, there's no such thing as a free lunch in the investment world. Higher returns often come with hidden risks, and in this case, it could be the risk of defaults. So always prioritize the safety of your capital by choosing funds with a strong credit quality track record. Now let's address a risk that might not seem as apparent but is equally important to consider. Liquidity risk. Liquidity, in simple terms, refers to how easily you can buy or sell an asset without causing drastic changes in its price. In the context of mutual funds, liquidity risk comes into play when a fund invests in assets that are not easily traded or sold in the market. Imagine a scenario where you've invested in a real estate mutual fund, or perhaps a fund that focuses on small-cap stocks, which are shares of companies with relatively smaller market capitalization. Now, suppose an unexpected event occurs, and you need to access your invested money quickly. In such a situation, selling real estate assets or even small-cap stocks might prove to be challenging, especially during market downturns. Why? Because finding buyers willing to purchase these assets at a fair price might take time. And what happens when a fund faces difficulty selling its underlying assets? It might struggle to meet redemption requests from investors who want to withdraw their money. This could lead to delays in processing redemptions, or in more extreme cases, the fund might even impose something called exit loads, which are essentially fees charged on withdrawals to discourage investors from exiting during turbulent times. So, how do we navigate this liquidity conundrum? Well, one of the simplest yet most effective ways is to stick with open-ended mutual funds that have a track record of high liquidity. Open-ended funds allow investors to buy or sell units at any business day, providing a great deal of flexibility. And here's a pro tip: large-cap mutual funds and liquid funds, by their very nature, tend to have better liquidity compared to other categories. This is because large-cap funds invest in well-established, blue-chip companies with high trading volumes, while liquid funds invest in short-term, highly liquid money market instruments. So, if easy access to your money is a priority, these funds could be worth considering. And finally, let's tackle a risk that often lurks in the shadows but can quietly eat away at your returns over time: inflation risk. Now, we've all experienced inflation in our daily lives, right? It's the phenomenon where the prices of goods and services tend to increase over time. And while a little bit of inflation is normal in a growing economy, high or persistent inflation can diminish the purchasing power of your money. Think of it like this. You invest your hard-earned money in a mutual fund and it generates, let's say, a decent return of 5% in a year. Sounds good, right? But what if, during that same year, the inflation rate in the economy is running at 6%? This means that while your money might have grown nominally by 5%, the actual value of your returns has been eroded by inflation. In real terms, you might have even experienced a slight loss in purchasing power. This is the insidious nature of inflation risk. It silently chips away at the value of your savings over time, making it harder to achieve your long-term financial goals. So, how do we combat this silent eroder? Well, one of the most effective ways to outpace inflation is to invest in asset classes that have historically delivered inflation-beating returns over the long term. And that's where equity mutual funds come into play. Now, I know we talked about market risk earlier, and yes, equity funds can be volatile in the short term, but over longer time horizons, they have the potential to generate returns that outpace inflation. How? By investing in companies that are themselves growing and adapting to inflationary pressures. And here's a pro tip: index funds and diversified equity funds in particular tend to be good bets against inflation. Index funds track specific market indices like the Nifty 50 or the Sensex, providing broad market exposure. Diversified equity funds, on the other hand, spread their investments across a basket of stocks from various sectors, reducing the impact of any single stock or sector on the overall portfolio. This diversification helps mitigate risk while aiming for long-term growth. So there you have it, a breakdown of the key risks associated with mutual funds and, more importantly, how you can minimize them to protect your hard-earned money. Remember, every investment comes with its own set of risks, and mutual funds are no exception. But the good news is that by understanding these risks and adopting smart investment strategies, you can manage them effectively and make your money work harder for you. If you have any questions or need further clarification on anything we've discussed today, please feel free to drop them in the comments section below. I personally read and respond to as many comments as possible, so don't hesitate to reach out. And before you go, I'd love to hear from you. Which type of mutual fund risk worries you the most? Let me know in the comments. In our next episode, we'll be diving into the world of taxation in mutual funds. Save more, earn more. So, make sure you hit that subscribe button and turn on notifications so you don't miss out. Until next time, happy investing.